Hey everybody, happy Saturday. It is September 7th, 9:27 a.m. Eastern Time. This is Chris Bowler here. I was doing a little kind of weekly recap and outlook of where we're going. If you followed in my videos this week and any analysis here on TradingView, price really did what I expected it to do. It did drop. It actually fell to the levels within 1 week of kind of where I was expecting. If we had some chop in September, having a big day on Tuesday, and then indecision Wednesday, Thursday, and another big day to the downside on Friday. A lot of that was just driven by U.S. labor news. So let's get into the details here. So basically, we had let's recap. Number one, it was a holiday shortened week. We come right out swinging right after Labor Day with a pretty terrible day on Tuesday with the market dropping. So that did two things. To me, I was trading some bearishness up here. I had some bear call spreads, some broken wing butterflies. And so once that first kicked in, bear call spreads looked really good. Broken wing butterflies looked pretty safe. Took a lot of profit out of those trades through that Tuesday, Wednesday, Thursday, Friday expirations. So that worked out pretty nicely. And then Wednesday, Thursday had some intraday trades. Friday actually ended up pinning, uh, almost pinning a butterfly spread. I had a trade that cost me about $4. I didn't write that very well. I had a trade that cost me, it was a $4 trade on ES. So it was an ES trade right here. I paid $3.50 for a debit. I paid $4 for a debit. If you're not familiar with the butterfly, I'll show you what it looks like in just a moment. I ended up closing those trades out for, let's see here, $17 on one. That was a $17 credit, and then a $21 credit on the other. And the max profit by the end of the day when cash settled for that ES contract, the max was around $23 and $24 credit. So I did leave a little bit on the table there, but I managed to trade, through the afternoon. It worked out pretty well. That butterfly trade looks something like this, where price was falling. I put the trade on. This would have been a trade for Thursday. I placed it for a Friday expiration, and price is here. If you're familiar with like an options risk graph, price is here. I had my risk on the butterfly trade. I had my profit trap, and then my risk. And so price fell on Friday, ended up going into my profit zone, into my peak zone. And one of my trades settled right in here, which was pretty darn good for kind of pinning that price. And the other one settled right in here. So they were both in that profit trap. The max profit would have been somewhere around like $30 credit. So it was just kind of over that profit trap peak, but still really, really nice trade overall. And I'm not saying that's a super high probability trade, but when it pays out really well. So last week, income wise, is actually pretty decent. And let's talk averages here. So employment data was not great for the U.S. and coming out with a rough day on Tuesday. We didn't really have a lot of news outside of manufacturing PMI. Wednesday's news was JOLTS job openings. It was a miss. So let's just highlight this. So JOLTS was 8.09 million forecasted, and it printed 7.67. So that was a miss, right? We also had a revision and a lower revision, and that was from 8.18 to 8.91. 8.18 to, I'm at 7.91. So another revision to the downside. So not looking great on job openings. We go to Thursday. We had a precursor to non-farm. That's ADP non-farm. Let me go to this right here. Okay, so then we had non-farm. Actually, it's ADP non-farm. And it was forecasted 231 and printed 227. This is in the thousands, so 231,000 and printed 227. And then we also had unemployment claims, 231 expected. Actually, that's what I meant. 231 was the forecasted for the unemployment claims, and then printed 227, so slightly under. This was expected 144K and printed 99. So this was a decent miss for the ADP non-farm. All right, and then ISM, we had manufacturing ISM under 50. We had services PMI, the ISM services PMI above 50 at 51.5. But then it was on to non-farm. This was Friday. And job-wise, we had forecasted 164K forecasted, and we came in 142 print. So that was a miss. We had unemployment rate was previous 4.3 and then printed 4.2. The way that I read that is that might be considered a slight improvement, but I think that could also mean that more workers are leaving the workforce and not being accounted for the ADP non-farm or the non-farm prints. And then also we have average hourly earnings. Average hourly earnings was 0.3% forecasted and then a 0.4% print. All right. So knowing that this week was all about jobs, the U.S. didn't really make any reassurances that things are looking better. The labor market continues to look softer. This feeds right into the slowdown. The numbers that I saw change quite a bit from last week were actually on the Fed Watch tool. The Fed Watch tool, you can go out now to December of 2025, and the forecast is that the Fed rate is going to be under 3% by the end of 2025, which is pretty staggering. The expectation for September 18th is still a 25 basis points cut, but the percentages continue to change. Whether it's going to be 25 basis points or 50 basis points, we will see. We can take a look at that with the Fed funds rate when we start that cutting cycle. I shared that in a previous chart. When the Fed starts cutting cycles, it usually doesn't bode well for the stock market. On top of that, you also look at the comparison to the yield curve becoming disinverted. That all happened this week for the first time since 2022. So going into next week, why am I talking about this now? Because labor market didn't make any upside surprises. Historically speaking, September is not a good month for stocks. How much worse does this get? I mean, I think that with this move that we had on a Tuesday and a Friday, that was really the directional pushes we saw this week. The market's already moved well beyond what September typically gives us. So September effect, historically, September effect is, it's historically a bearish month. A bearish month. Now, the 10-year average is around 0.9% negative. So I'll put negative 0.9. Okay. Let's say return. And the 70-year average is around negative 0.72% return. So both of those, with a lot of history to them, less than 1%. You go from this recent high to this recent low. With the close, we're down around 4.5% from the high to low, about 4.85%. I'm not saying that we can't go lower. In fact, we could go 10% down and 8% up or 9% up and then hit right within these historical averages. So if we're about to see a lot more volatility, then perhaps this market is going to retest lows or retest something like this where we have some indecision and some high volatility. We'll keep an eye on the VIX for that. But when the month is over, where are we at? If we're coming down here, does the month have a way to rally back up and kind of settle right back in where we started and we come within, average levels of that September effect? Maybe. But I think traders should be ready for some volatility because we're certainly getting it right out of the gates. Coming into inflation news next week. Inflation news, we have CPI, and that's going to be, I think it's a Wednesday, Thursday release. Let me confirm that here. So Wednesday, we have CPI. Yep. So Wednesday, this will be September 11th. So Wednesday, September 11th, we have US CPI. We're looking at core month over month, 0.2%, and then CPI month over month, 0.2%, and then CPI year over year, which is what a lot of people are watching. So the year over year is forecasted from a 2.9 previous print to 2.6% forecasted. Now, I do think that inflation numbers will probably fall in line somewhere in this area. Why? Because employment numbers have been softer, the markets have been dropping, and the big thing here, I know that core CPI doesn't include food and energy, but if you look and see what actual CPI is doing, energy has been falling, right? Oil's been down. Oil has breached $70, and if that's going to take effect where we've seen some highs in oil and it's continued to slide lower, into some pretty decent support. I mean, I had a chart alarm go off last week at 67.50 on CL and on US oil. So right here at 68.08, I mean, we breached that $70 support, and the next zone to me is 67.50. So if that has any influence in what we read on CPI, it's really the lagging indicator is shelter. But food and energy, food prices have come back down quite a ways. and then energy is now dropped a decent amount. I mean, if you look at oil, let's take a look at oil for a moment. Okay, this thing has been just beat up since the top here in July. Oil is down around 19.5%, almost 20%. There's your alert right there around 67.50. Like I said, we tapped that 6700 zone. I have some trades running on CL. We're at 67.67. Again, probably down closer to 20% here from this recent high in July. That is down about 20.5%. Now, looking at the volume profile here on CL, there's not much to the downside. I'm not saying that we can't go lower. Certainly, there's issues. I mean, we have U.S. production at nearly all-time record highs. We have some Middle East tensions that aren't raising the price of oil, but we really have global demand that is pushing this into a steeper slowdown and decline. But you look left on the chart, there's plenty of support back here in 2023, plenty of support back into 2022. We go back into like 2021 to now. I mean, this has been a pretty big level of support on oil. Now, it could fall deeper, and if we break into the low 60s or 50s, that's understandable. But if we stabilize here between like 67.50, $65, these are the levels I've been watching for to see if I can take some stabs and then get oil to kind of base and stabilize. It's not really oil making crazy highs and having this huge range where we're going to come back to like 120 bucks. It's mostly, can we stabilize around 70? Can we work our way back up into like 85 or 90? If we can, cool, that's where I'll be looking to trade it. So I did put on some pending orders on CL. So I'll go to the CL chart, which I'm at right now. I put on a 65 by 60. It was a 65.50. So 60, I'll just type it out. A 65.50 by 64.50, 65.50. That's a sell put. And a 64.50. And that's a buy put. So it's fine risk. I'm going after 50 cents credit. So that's about a $500 reward. And I'm risking $500 as well. So it hasn't been filled yet. That's still a pending trade, but that's out there in case we drop a little bit lower and we end up finding those areas. And I want to see, that's actually it's a November expiration. So I'm going out to November, which I might end up regretting. I hope I don't, but I was thinking I can give it enough time to see if it stabilizes, sitting at these nice low levels and support levels. But seasonality wise, we typically do have lower prices going into the later parts of the year, where most of the peak demand is going to be in the summertime. So I will possibly reassess that trade next week and then maybe put in something for like $60 support as opposed to 65. But I'll assess that on Monday. We come into next week's trading. Let's take a look at a little bit of everything else. So, ES feed, like I said, we dropped right into some nice levels. I actually had a couple of good trades work out. I had some broken wing butterflies up top, which worked out well. Some bear call spreads, which worked out well. And my personal highlight for the week, not a super high probability trade, but when it does pay out, it pays out a ton. I had a butterfly spread that worked out really nicely on ES, and it looked something like this. I had the trade in from Thursday with a Friday expiration, and when I got into Friday's trading, we started to push lower. Real price was right in here. Here's the risk on my trade. There's my profit trap, and there's my additional risk. So the trade looks something like this, where this is my debit. I paid about a $4 debit on the ES contract, and I had another one for $3.50 that was just shifted over slightly. So it's essentially like taking two of these trades, and this $4 debit ended up paying out $17 and change. I closed it out for $17 of credit, and then I had one that I charged me $3.50 debit that ended up paying $21 because it was slightly over and closer to my pin price. So price started here and all day worked its way in, got into my profit trap, and then of course as expiration nears, my kind of my money line becomes like the actual trade itself, and so the real price settled in. Put a different line here. The real price settled in right around this area on both of those. And so it was in my profit trap, in my pin price. The pin price would have been spot on there, but these both ended up closing out for about $23 to $24. That was like max profit, would have been cash settled. I closed it out a little bit earlier, but still made some good returns on that one. And like I said, it was just a trade that I was looking at liquidity levels, looking at some support over here, and fortunately got the timing right and worked out really nicely for Friday. As I move forward, where do I think I'm going? I actually took on Friday a couple of short-term income plays. I did it on the SPX. So here, after selling off a decent amount, we are showing some downward movement. But I also think that this softer employment number was kind of front loading the September effect. Um, I'm taking some income stabs, and here's how I'm going to do it. Basically, I took a 5410 by 5405, collected $2. It was 205. And then I did another one out a little bit farther. This was out to the 13th. So this is going to next Friday's expiration, little income stab. I'm risking $2.95 to make 205. All I need to see next week is if we stabilize a little bit on positive inflation data. If we do that, maybe we pull back and we actually have a low to a high for the week instead of just additional bearish pressure. So if that doesn't work, what I'll do is this is a one contract trade. If we go lower, I will find some support down here. I'll do the same type of trade, take a two contract trade. I don't necessarily think we're full on crashing in September. That would be crazy. I know the September effect is a bearish month, but to what degree? I think it's going to be somewhat contained because most likely after we get through this news and we get through the Fed, that's really the biggest news coming up in September. Is September 18th is going to be the Fed. It's going to be 25 basis points cut or 50 basis points cut. I don't know. I think if the Fed cuts 50 basis points, that probably shows that they definitely miscalculated on timing this cut cycle. And inflation data, if it prints at 2.6 or 2.5 and actually shows we made a big chunk to the downside, that does justify maybe that 25 to 50 basis points cut and then additional cuts through the rest of the year. I wouldn't be surprised if the Fed is down another 75 to 100 basis points by the end of the year. So from September 18th to December this year, we might see a 1% difference in official cash rate by the Fed. Does that mean that the market can't run with that? Not necessarily, but again, let's just stack up what we have that's really important as far as the catalyst goes. So we get through inflation data this week. Okay, inflation data this next week. Then we have September 18th, Fed. What has happened? That was weird. Sorry about that. If you saw like this shade on my screen, September 18th, FOMC. And after that, I don't really know what the major news is. You're going to come into, yes, you're going to have another round of inflation data in October. You'll have another round of employment data in October. But from there, it's going to be all about the election. So, yeah, yes, you'll have more, employment news, more employment, more inflation, right? So the market's going to want to see it, but then it's all about the election. And I don't know if either candidate really matters to what the market's going to do. I do think a lot of the stuff is already predetermined and predestined anyway. I'm just trying to keep the risk, under control, take stabs, generated some income, and if I have good opportunities to scale in long term, I'm going to. So this is what the market's going to be digesting, which is why I don't think we're necessarily full on crashing. I think this will be somewhat contained. So if we have, let's say, something along these lines here, okay, maybe. Or we have, and I mentioned this before, maybe a wedge like that. So either a wedge, okay, or some channeling to the downside. But September could be just another wild ride where the volatility index maybe spikes up a little bit, then flashes back down. We could keep an eye on the VIX as well for this next week. If the volatility index, which did rally nicely from 15 back up towards 23, I mean, obviously, if it gets more elevated, there's going to be some more pain ahead in the stock market. But if we start to see that this little peak in volatility starts to fade, then most likely that 4.5% decline we've already seen is going to start looking at some short-term bottoms and maybe pull back and find some efficiencies if the buyers are still interested. So I do expect some further chop in the market. That's what I'm looking to trade. Taking some income stabs using trade sizes. If I'm wrong, fine. I'll get into better levels, increase the trade size, try to make some net gains. Looking at some other instruments here. Let's go to gold. Okay, gold is still sideways. I talked about this in a couple of other videos, but it's quite possible that gold is setting up for a rising wedge and then coming out to a outer trendline type behavior. I'm watching this closely because rising wedges can be this perfect little setup for a correction, but then it becomes that's all it needs. It needs a correction. It cleanses itself, and then we have some big buying opportunities at the base of this wedge. So I do want to keep an eye on gold for that reason. The other way this plays out is this could just go sideways, sideways, sideways. Everyone is ready for this thing to break to the downside, and then it fakes, and then it blows the tops off. I don't know. But with the Fed getting super dovish or potentially getting super dovish to the end of the year and even into 2025, gold seems like a pretty logical play for higher highs, but it would almost be too easy to see gold just go higher. So I think a little bit of let's see who's really interested in the bigger picture trading. for gold? And if so, let's see if we can find some support around this 2300 zone. I'm still long gold. I'm long GC. I'm long GLD, and I'm looking to take my stabs where I can. I'm not super aggressive on it right now. I'm actually building more of a position on silver just because technically I like it better. Silver, and I'm looking for something like this on silver. We're just making lower highs. We have previous resistance becoming support. I would like to see silver stay within this area here, consolidate. My aggressive additions will be once we get some confirmation outside of this 29.30 zone. If we have a fake out trade where we have $26 tested and then find support, I'll probably establish some long puts in or some sell puts in here. Some possibly long calls. Long calls are going to be up here when I get some directional confirmation, but some credit spreads in there as well. So I do want to add to my silver positions. With the NASDAQ dropping, so we had the SPY down this week a decent amount. We have the NASDAQ as well. So this is the QQQ from this recent high. This is down. I mean, just September alone from Tuesday to Friday, this thing dropped about 5.25% off these recent highs. I mean, the NASDAQ looks worse for wear compared to the S&P. But take a look at this. If we have a higher low and we have a lower high, we could see some indecision and more of a wedge where maybe the data just doesn't really drive us any lower, doesn't drive us any higher, and we have to trade this internal chop, which does make some sense to me. The Dow hanging in there a little bit, off the highs. We still have some decent structure and support. Trend line there, trend line there. Russell looks pretty much the same. The Dow has room to possibly fall a little bit more, but I'm looking for buying opportunities on the Dow as well. And the Russell, same thing. We did not have a great week on the Russell. I'm not sure percentage wise if it underperformed or outperformed, but from recent high to low, that's Tuesday to Friday, almost 5%. So it's slightly, I guess it was a worse performance than the S&P, but slightly better. And that's obviously relative. When this is down 5+%, this is down 4.8%. They both are terrible, but it's down a little bit less than the Nasdaq. But still higher lows for right now on the Russell, and keeping a close eye on the structure, watching for that high as well to see where support sits. If we drop a little bit, we did fill this gap. We come back in, there's plenty of support around this 200 handle on the IWM. So I actually wouldn't mind, again, credit spreads would be pretty simple. Define risk. If we come down to that zone, look to see if we just stabilize and form that bottom. I could put some credit spreads in there, stagger them out, and maybe generate some nice income on the IWM. VIX, I'll keep an eye on that one for next week. We go to gold, gold rising wedge potential. I'll be keeping an eye on that. I'm still going to be long on gold. If it comes back down with this rising wedge correction, I'm still looking to buy it around 2,300. Nothing big, probably just risk defined, taking a couple stabs and then establishing that stability for me to get longer. And then silver, wanting to see some clean breaks above 30, and then measure moves up to 35. Bitcoin has been pretty rough. I mean, Qs are down, Bitcoin's down. Noted some of these levels here, 43,000 on this volume profile. Also, big liquidity zone, some inefficiencies around that 40 to 43,000. A lot of price chopping here as well. We're making lower highs, lower lows. Okay. Now, to me, this is, I mean, look, for everyone that loves Bitcoin, they're just buying more. It's pretty simple. I mean, it's from here to here. It's a percentage. They're down. They're going to buy more. If it comes down to any of these levels, buyers of Bitcoin will continue to buy. The transaction in Bitcoin will be once we make all-time highs. So if we somehow, and this is what I'm really looking for, I need to see where price is going to stabilize. And I'm not necessarily interested, nor am I going to be good at any time picking the bottom necessarily. But I do want to see something give us. Let's say this is a high, lower high. If we make another lower high, I would like to see at some point like the structure changes. So let's say that we settle back into maybe a $44,000 to $40,000 low. If we see price getting back up here and taking out one of these previous highs, then I'm a little bit more inclined to think that the structure is changing for the bulls to be back in charge, a swing trade that we can build and then project, and then we can see if we can break these all-time highs. The destination 100K for the end of the year might be a tall order, but also with the dollar weakness that's probably likely to come and prevail over the next 12 to 24 months, Bitcoin and gold are pretty good alternatives for that. And if that is the case, I could see, if you own assets, if you own stocks, you own Bitcoin, you own gold, you own silver, outperforming the dollar, I think that's a pretty good place to be. We also know that, Bitcoin, when it gets its runs, it does run really nicely, and we're looking to just see a bullish pattern appear. So I do want to watch Bitcoin closely. I'm still, obviously aware of like some of the big structure levels between this 40 and 45K zone. Could it pull back to 30K? Maybe. It would be the same thing if we made, let me just clean this up. So if we made lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low. If we did that structure all the way back into 30,000, fine. I'm just going to watch and see how this behaves. Because once we're here, and sideways, I could establish more of a core position in here, look at swings, get back to highs. There's huge return just on that trade alone. If we range from there, okay, fine, that's a longer term range. But if we rip from there, this is where I'd want to be establishing that position on that confirmation. So I don't think there's any reason to be in a hurry on Bitcoin outside of keeping some dry powder on the sidelines, dollar cost averaging in some pretty key levels, and going from there. Otherwise, Ethereum also down a little bit, just shy of those August 5th lows. We've got the Japanese yen. Okay, Japanese yen, this is 6J, so the feed for the Japanese yen futures market up for like 4 or 5 trading days. The Nikkei has been down 1, 2, 3, 4 out of 5 trading days. And this, begs the question, is the Japanese yen unraveling again? I don't know. I mean, part of me thinks with this crazy price action, just ignore the macro for a second, ignore the fundamentals. If all this did was pull back here and then go to the upside, it might struggle to break the highs and the lows. And so we just deal with volatility on the Nikkei in here, which means volatility on the Japanese yen with no clear direction. So I mean, I'm watching the Nikkei, but I could see a pullback in here that all of a sudden we don't make a lower low, but rather higher low. And then the Nikkei has plenty of upside potential just to come back into these zones. And short-term trading could be pretty nice. But I'm not interested in, longer term look. Longer term, probably long the Nikkei. Longer term, probably long the SPY. Longer term, like it's been for 70, 80, 90 years, long the US stock market. But is it going to come with some pain and some drawdowns along the way? Yes, probably. But as great investors will say, nobody knows where the next 500 to 1,000 points is going to be. But the next 5,000, the next 10,000, probably to the upside. And it's just you got to figure out how long it's going to take to get there. Keep your risk, under control. Don't do anything stupid, and you'll survive. So we don't have to make it complicated. I probably am far more active than most when I'm trading, 50, 60, 70 underlying symbols, also generating income here and there. But, I take losses along the way. I have winners along the way. This is what I do. This is what I trade. But for the simple investor, there's no reason to even think about like, oh, what's it going to do next month? Who cares? Longer term, is it going to be higher in the next 1, 2, 3 years, 5 years? If it is, it's worth investing. Is the dollar going to get weaker? Probably, right? Is Bitcoin going to go higher? Maybe, probably. I hope it will. But everything else is like, we don't know. Nobody knows. So at the end of the day, this disinversion, I think, is something that we have to pay attention to. So here's the 10-year and the 2-year, right? So we're officially disinverted. That's not historically a good sign. So there's a lot of things that could be stacked up against the market, but is it starting right now, or is this little reality check going to be kicked down the road, post-election, maybe into Q1, Q2 of 2025, maybe all the way into 2026? I don't know. But we will find out, because one thing that is likely going to happen government spending wise is we're going to have government spending. Whether it's Republican, whether it's Democrats, there's going to be government spending. The purchasing power of the dollar is going to get worse. If you're in assets, that's the best place to be. I don't know how much exposure you want to have necessarily in stocks, but I will say that over the next 1 or 2 years, bonds are going to get less and less attractive. Or I should say yields rather. Bonds themselves might be fine. I mean, I had a chart alarm on TLT go off $100 and I think 101 this week. We spiked up here towards 100.80. I have a diagonal spread on TLT from an 82 to 103, and I'm pretty excited about this trade, hopefully getting it called away at 103 or higher. But bond yields will be doing this. Bond yields likely pricing in more cuts. Bond prices, inverse to that, should be looking better and more attractive. So I do like bonds. I am in the TLT. If you want to go that's the 20 plus year route. If you want to go shorter term than that, the IEF is a 7 to 10 year. You can see it's behaving pretty much the same way. So if yields are dropping, bonds are going, I think that's a good place to be for right now. This actually could be measured pretty simply. There's a low, there's a high, there's a higher low, there's a higher high. We're not quite there yet, but the symmetry's got to be close. And that's what I'm trading on TLT. So there's a low to a high, and then plot that symmetry. We're just shy of that symmetry on the 10-year, just shy of it. Let's go 20 years, so I'll go TLT, and then I'll let you go for time's sake. It's been about 30 minutes. So I appreciate everyone being here watching this video, by the way. I didn't mean to go this long, but, that's what happens when we have stuff to discuss. and there is a symmetry swing for TLT. So right in there, 105, 105, 105.50. That's my symmetry swing, which is why I'm long TLT. So recap for this Saturday is markets are down and kind of front loading the risk in the September effect. There could be more pain to the downside, but I would watch that August 5th low. If you're 10+% off the SPY highs, if you're 15+% off the Q highs, I look at it longer term as a buying opportunity. Historically speaking, it's always proven pretty well for 70, 80, 90 years. Short term, keep an eye on things. We could have a little bit of, employment news was really terrible, but inflation news could be pretty uplifting and pretty positive. That happens this next week. So if that's the case, we could see a stable move off of, we had a 4% correction, then it pulls back, and now it's a 1% correction. Now it's a 2% correction. Big difference. So we'll find out. But yeah, stay tuned for more. I'll post more videos next week. And thanks for watching. Enjoy the weekend. I'll see you soon. Thanks. Bye.